So hello, my name is Lizette Chapman, and I cover venture capital for Bloomberg. And with us today, we are going to talk a little bit about in search of the unicorn, kind of how you get there. But we've kind of started renaming the panel and talking about this right before we came up here, and we think it's a broken system, or possibly it could be. So we're gonna kick it off here. John, you're gonna, if you could introduce yourself briefly, we'll just go down the line, and then we'll go into whether we think they're broken or injured.
Hi, John Collmer. I run JP Morgan's West Coast private capital market team. So we work directly with growth equity investors and companies, helping them achieve their capital achievements. Hey, what's up, buddy?
Hey, I'm Jules Maltz. I'm a general partner at IVP. We're a $1.4 billion late-stage fund. We've invested in companies like Twitter, Snapchat, both in the early rounds when the companies were less than 30 people, but with amazing consumer metrics. Done a lot on the enterprise side with Tanium, Domo, AppDynamics, Slack, Dropbox, and I've been at the firm for 8 years.
Yes, Sven. I work for Sharespost. We have two major business units. One is the largest exchange or platform for private secondary transactions in late-stage companies. And the other one, it's where I'm involved, is the Sharespost 100 Fund, which is a late-stage $500 million fund investing in late-stage private companies.
Thanks, guys. So we've got this massive herd of unicorns. You guys have all heard about it. It's been everywhere. I think even Anand earlier today had a graphic showing how media mentions and buzz has gone up, and now it's trailing down a little bit on unicorns. I think it's the latest total is 168, worth 600 billion or so. Sven, you described it as a party where everyone keeps coming in and nobody leaves. I don't know if we could go down the line whether you think that we've finished seeing some of the valuation haircuts that we've seen recently, or whether you expect some more. Are these growing, or are we going to see some more haircuts?
Well, you put me on the spot here.
Yes, I did.
So perhaps we should step back a little bit and think about what are our expectations when you invest in these companies. And if you're in late stage, you cannot expect, even then, that each and every company goes up in valuation all the time. So you have to step back. If you look 12 months ago, 18 months ago, everyone was saying it only goes up, 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 up. Statistically, historic average is that still 30–35% of these companies at that stage will face a correction. And this is what I'm looking at, is are we still in a historic average of corrections? And this is where we are. All the names and everything we are talking about, all the valuation corrections of a Fidelity or a T. Rowe Price, if you make the math, they are below 30% of their portfolio companies are corrected in value. The remaining 70% of their portfolio companies hold at 81% above their cost, generating a 17% IR for them. So in the end, is we have to step back. Yes, there are corrections. Yes, it is a historic average. We will see and continue to see correction in companies. As long as it is about 30–35% of the companies, we should not be concerned. If it goes to 45, 50, 60%, then well, I think we have to talk about something else. We are not there yet.
Yeah.
I think, too, to kind of take a step back, we're just looking at an equilibrium situation here right now where there's been a change in valuation. Buyers and sellers are trying to figure out what is the right price to make a future investment. I keep everybody in mind, 2008, Lululemon went public right before the correction. You could have bought Lululemon at $8, right? Market's correct. It doesn't mean the company is broken, the fundamentals are broken. It's a dislocation in value, and Jules does this for a living. I mean, you see this. These are opportunities where you get to invest in really good companies. And so I kind of remind people of that, and I remind them it's not broken, it's opportunity.
Yeah, I mean, I think the biggest problem was the companies optimizing for the wrong things. So because of the media coverage around unicorns, there almost became this unhealthy obsession with trying to become one. You almost felt like you didn't matter in Silicon Valley unless you were a unicorn in a late-stage company. And so what that caused is companies to take on too much capital, or to take on capital at valuations that then came with terms that weren't advantageous. And so all of a sudden, companies are optimizing for valuation, and it's great. You raise $100 million at $1 billion, you know, it feels really good on that day. On the next day, when you figure that you're burning a lot of money all of a sudden, and you got to figure out how to actually grow into that valuation in an IPO market that's massively changed. You look at the Twilio IPO being priced at 3 times next year's revenue. You know, how many unicorns at 3 times next year's revenue are still worth over $1 billion? Not 167. It's probably 10% of those. So I think like as that change has happened in the ecosystem, there's going to be a lot of dislocation, and I think there's more pain to come. I'm definitely listening to the last panel. I'm a bear in terms of the very pre-IPO late stage market in terms of the valuation corrections that we're going to see over the next 12 months.
Really?
Except in our portfolio, amazingly enough.
Well, let's ask. What about you, John? Bear or bull?
I'm bullish, and here's why. Brighter days are always ahead. You look at Intel did a down round. There's really good companies in the past that have done down rounds. OpenTable did an IPO in the worst market in 2009. Look what that company became. The truth is you have to look at the business model. I think, Jules, the disentangled parts Jules had there is look at business models, and if the company is meeting a need, and that's your most important question you got to write on your mirror in whatever marker or lipstick is, what is the need I'm trying to meet? And if I can do that, I need to find the right capital partners. If you get the valuation wrong, guess what? That's life. Like what you then need to make sure is you're surrounded by good partners like IVP, like I see Ash here from Wellington. Like these are the people you want in your foxhole to get you through the next step. And if you get to the other side, you're going to have a really good ride. I'm bullish.
Bullish? Bear? Bull bear?
Well, I think it's just going to be because companies optimized for valuation and didn't understand the fundamentals of their business or didn't focus on valuation that was tied to the fundamentals of their business. There's going to be a lot of dislocation. That doesn't mean there's not going to be some exceptional companies that deserve their multi-billion-dollar valuations that could grow even further than that. And so we're definitely bullish on some of those companies. Will those companies, to Sven's point, outweigh the ones that decline? Potentially. But I just think if you look at the number on a pure numbers basis, you're going to have the majority of companies that raised money over $1 billion face rounds that are potentially at or below that over the next 12 months.
I answer that a little bit differently. I feel like a kid in a candy store. Let's frame it that way. And the main thing is that because of all what is discussed, of all that is written in the media, the expectations are more realistic, similar to what we heard on the prior panel. This is a more normalized environment, and this is the good time generally to invest. The other thing is, very successful investors in venture are continuously in the market. This is a long asset class. Even in late stage, our exit horizon is 3 years. Who knows what the market condition is in 3 years? If you're on early stage, the exit horizon is 10 years. Who knows what the exact market environment is in 10 years from now? Successful investors are in the long term. Just one additional comment to the general unicorn or late stage market. I think even with a larger inventory, 160 plus unicorns, less new formation, but there's a reconfirmation of these rounds. We had in Q1 and Q2 the largest quarters of $100 million and more rounds. This is like the used to be public rounds. So if you look at financing round, $100 million or more, how much capital is flowing into? Q1 was the largest quarter ever. Q2 seems to trail quite closely to it. Even if I subtract in 2 quarters Uber, is a massive capital inflow in late stage venture companies. The companies stay private longer. You have 10 to 15 billion dollar exits per year. So that will not generate a big outflow. You will have continuous inventory of massive, big private companies. The companies will stay private, and only the IPO is an exception. We should not assume the IPO is the rule. This is where it goes.
We've got a big IPO coming this week, potentially the second tech IPO in the United States this year. Twilio is set to price. How big of a deal is this in your guys' ecosystem as we look at this massive buildup of this party of everyone coming in and not necessarily leaving in the exit market? How much of a litmus test do you see Twilio?
You guys are on it, so can you talk about it?
Please do.
I can talk generally about the market. What I would say is it's a good thing. You're starting to get data points of companies that are entering the IPO market or just data points around valuation, to Jules' earlier point, is we needed this. We went through Q1 where things seized up, and you had this equilibrium where Jules pointed out a 7 times multiple went to a 3 times. Well, an entrepreneur, you guys are sitting here, you know it. You know what you're building, you're confident in your business. You're not willing to sell at 3. So I think more of these will be good. We just announced a deal. It's public. We worked with Telogis. They sold to Verizon, which these are good data points because it's showing validation of your hard work. It's showing validation of multiples around business models. But your thoughts?
Any other comments on the IPO, or can we jump into M&A? I realize that we only have 20 minutes. So.
Yeah, just on the IPO, I would say, be careful to measure against one data point. The statistic error on one data point is 1. It's 100%. So I can make 2 predictions on that IPO. If it's going well, everyone will say, great, now everything is over, and others line up. If it goes bad, everyone will say, oh, the world goes down. Yeah? Again, statistic error on one data point is 100%. Maybe be careful.
By show of hands, who's close to doing an IPO in here? All right, cool. So that's good to know. Like, definitely.
It's 500 startups, though.
Well,
it's
no,
like,
I mean,
come on.
But that's why I think the M&A discussion would be good for everyone.
Well, let's jump into that right now. There was Microsoft acquiring LinkedIn, which was a large one. There's a lot of other deals brewing out there. There's been a lot of speculation because corporate balance sheets are very big right now for many companies, and there's a lot of valuations being reset. So some corporates are saying, hey, great time to go shopping. We have Mark Andreessen talking about that at the Bloomberg conference last week. What do you guys think? What are you hearing? Do you think there's going to be a big spike, mellow spike? What are your thoughts on this?
We've seen a lot of pickup, especially in the public markets. And one of the reasons that I think it's almost easier to do public M&A because the price is more discoverable. A company knows what they're trading at. With LinkedIn, you saw their price, I don't know if it got cut in half, but it basically had this huge decline.
40%.
40%. And then Microsoft bought it at a premium, but kind of similar to where it had been trading before, right? And you saw that a bunch with a lot of the SaaS names like Marketo that got bought. So I think that the price discovery is easier when you're dealing with the public markets. In the private markets, it's actually harder to do M&A because companies haven't done that reset, or it's not as visible that reset's happened. So I think we're seeing less private M&A. I was involved in a company called Steelbrick we invested in October that then Salesforce bought it a few months later. So definitely it's happening, and some of the big companies are being acquisitive in different areas, and we hope for more of that. But I think we're actually going to see more M&A on the public markets than the private, at least by dollars.
And I would say I think you see more. I agree. 52-week high is a big number in the public market. So, the correction occurred. The farther away you get away on the 52-week higher, that comes in, which it just essentially means corporates are more willing to put a bid in because it's not insulting, right? On the private side, you've seen insiders do rounds which have propped valuations up. That's kind of slowing down the M&A because it's creating this hurdle. And this is something as entrepreneurs, when you pick a partner, you pick someone like Jules who will guide you, is you don't want to keep, if you do get in a situation where you have a value too high, there is a point where you want to start taking it down so then you have optionality for future fundraising or M&A. Because, look, at the end of the day, you need capital to grow your business. You don't want to be in a situation where you're kind of stuck in the cold. But
now, you say that, but I wonder how willing founders and entrepreneurs are to do that, to start taking it down to more rational levels, or versus take a lot of structure on so they keep the valuation high.
My mom asked me the same thing. I said, Mom, you'd never get a divorce without asking your mom. Have a good advisor around. Have a good board. That's the thing, is when you guys are building these businesses, that's what it is. These are minority shareholders in your business. They're there to offer advice to you. You want to surround yourself with that. It's, the good news is you're living through this, so the questions you're asking them is, do you have a company that did a down round? How did you advise them? These are the things you want, because they're the ones that will guide you.
So, just adding to the M&A. First of all, agree, on the public side, it's much easier, and I think just Elon Musk announced that Tesla will acquire Solar City for a 30% premium. That happened an hour ago. But if you look at a private M&A, realistic, we have even a normalized market, 10 to 12 tech IPOs per quarter, 10 to 12 per quarter IPOs, and we have 100 to 120 M&As per quarter. The acquisition is the dominant one. It went down a little bit over the last year to about 90 to 100 acquisitions per quarter. In the last 6 weeks, something happened. I'm not sure if we can call it already a trend. But in the last 6 weeks, there were a significant amount of increase of large M&A activities, and interestingly, at a significant premium. So you have revenue multiples of between 6 and 9 on these acquisitions, which is higher than a historic average of 3.5 revenue multiple. So there's something going on, coming back to the point that most likely corporations now see these valuations that were out of control about a year ago, where they couldn't afford to buy at these valuations, are now at a normalized level that they can buy, and they can actually afford a premium multiple of, let's say, 8x on a revenue.
We got flashed the time sign, so we've got time for one more question here. And I realize that we talked a lot about the early stage the earlier stage of the unicorns with some of the structure terms that you put in. And we talked a little bit about how that happens on the end with M&A and IPO options, but we didn't talk a lot about one of the major players that have been present in building up some of these unicorns, the mutual funds and the hedge funds. So I was wondering if you have any thoughts on the role that they've played in building up this very late stage market, and when we're going to see them come back again, because they've been largely missing so far this year.
The only reason I spent my first 10 years at J. Morgan running the public equities group out of Boston, so all of those people are friends. They're still here. The key thing is, here's what it is. Mutual funds are still here. Hedge funds are out because the asset class is out of favor. Mutual funds are looking for, and write this down because when you talk to them, it's what you want to say. It's market leaders. You're a leader in your market. You're addressing a big TAM. And guess what? You're the best management team in the space. That's what they really want because
Sounds like a 500 startups pitch.
And here's why. Because companies are taking longer to go public, as we heard, they need to come into this asset class and be there to find those winners early, right? They're not going to go into the space otherwise.
Yeah, I just say, no matter what stage you're raising money at, just think about whether you're actually a fit for that investor and that investor's a fit for you. So each investor at different stages does different things. 500 Startups does a great job at their stage. Great Series A investors do amazing. We think we do a good job in that Series C or D stage. If you're really getting close to an IPO, a public investor can be a great thing, but it comes with different things than earlier venture investors give you, right? They're not joining the board. They're not very rarely a board observer. So that some of the guidance and day-to-day stuff, you may even need to be cautious about sharing future projections with them because they could be future buyers of your IPO, or they may not understand a business model transition. They may report on your valuation publicly. So you may have valuations going up and down in the market that you didn't expect to get. So I think just understanding, are you ready for that? And if you're ready for that, they can be great partners. But if not, think about just matching your business to the stage of investment that's right for you and for the investor.
So remember, I'm running a mutual fund, so I'm still around, and I'm one of they, as you framed it.
It's a good thing.
The one thing to add to everything that is said is why are mutual fund manager like myself or others in it? The one reason is that growth is today happening in the private market. If you go back to the good old times when Apple went IPO, Apple was 5.5 years old, had $114 million in revenue, and grew 145% per year. Today, a company with that profile stays private. Yep. So public investors lose out on growth. The average growth rate on an S&P 500 is 5 to 6%. So that's why mutual funds, or in certain times hedge funds, go into the private world that feed that late stage venture, that feed the unicorn, because the growth is happening in the private market and continues to be there.
Good stuff. We'll see what's next. Thank you, guys.
Thank you.
Thanks.